Hello, everybody. Welcome to Finance 444. Welcome to week 3. You've made it through almost halfway, well, all the way through halfway through the course. And in a course like this where you have a final, you've made it more than halfway through the coursework, right? Because you've got 3 assignments. You've made it through 2 of them if you've caught up. You've got 3 discussion boards. You've made it 2 out of 3, and you've made it through 2 out of 3 of the assignments and assessments. So the regular assessments anyway. Of course, you got a final assessment next week. But congratulations, you made it this far. Hopefully you've been able to keep caught up. We've got a handful of you that are finding yourself a little bit behind at this point. I'd encourage you to get as much work in as soon as you possibly can. We're going to run out of time this next week there is a hard cutoff that we've discussed at the end of the course, Saturday next week at midnight, where we can't turn anything in beyond that point. So instead of running the risk of not being able to get things in, I just strongly encourage you to be able to get things in as soon as possible, get things done, work this week, and really put effort into your time management so that you can get what you need done. If you get stuck on anything, let me know right away so I can give you some feedback. If you're going to be late with something, it's respectful to give me a quick heads up that you might be late on something, but I can't do anything about the discount on your grade unless you've talked to the school and gotten an exception through the school. So if you're looking for some kind of exception for late work, you need to go to the school and check that out with them. If it's just normal late work because something came up and, family issues to computer issues, there's all kinds of different issues that come up that make us late on things. That's okay. That's the reason I accept late work. You'll get most of the credit, just not all of it. So I'd encourage you to get things in as soon as you possibly can, get caught up as soon as you possibly can so we don't run out of time and miss our chance to make sure and get the grade we want and pass the class and move on to the next thing. All right, point out again that we've got a learning coach for the class, so if you're stuck and you're not able to readily reach me or you would like to talk to somebody else about the class, they're available for help as well. All your grading from last week is done, so grading and feedback is already completed this evening. Let me know if you have any questions or concerns on that, but for those of you who turned anything in to this point, you should have a grade on it. If you don't have a grade on it, or if you have any question about it, let me know right away. So tonight we got a couple things we want to do. First of all, we want to discuss the assignment for this week briefly. Then we want to talk about Chapter 11 from the text, and we'll go through some slides associated with Chapter 11 on investment planning. And finally, we'll spend the last couple minutes, as we always do, going over the material that you need to know for this week's assessment. This week's assessment has 10 questions. They're multiple choice. It is not a hard test. This week's assignment has like 5 or 6 short answer questions that it's asking. It is not a hard assignment. You should be in great shape if you just put the effort in, and we'll go over how to do the assignment in just a second. All right. So I mentioned that we'd cover the assignment. Let's take a look at the assignment. It's one of the end of chapter, financial planning questions at the end. So let me log in to my other screen that I've got the questions on so we can kind of walk through them. All right. So this week's question is about Merck, which is a pharmaceuticals company. It basically says that if the stock appeared written this way, the pricing written this way on August 1st, 2012 on Yahoo Finance, answer the following questions. All right. So it's going to give you all the answers. You just need to be able to find the answers within the information that they've given. So let me give you how we're going to do that. So if you were on Yahoo Finance, okay, which is what they're taking the information from for this case study problem, and if I put in Merck as the company, which you're not going to need to do this for the assignment. The assignment's going to give you all the information that you need to pull from to get your answers. I'm just going to give you an example of what this looks like. Okay, so this information here to the left of the screen here is the kind of information you'd be looking at. You'd see a previous close, a bid, open, You'd see the big number up on top, right, the 5510. You'd see market cap. You'd see PE, which is price over earnings ratio. Yeah, you see a lot of information here, right? So the questions on the assignment are going to ask you about these different bits of information. They're going to ask you about the 52-week range that you can see there. That's the lowest price and highest price during the 52-week period. They're going to ask you what the stock dividend is. Here, look over here at the forward dividend, and you can see the dividend right. The rate is the 3.32%. The actual dollar amount per year is 1.88. Okay. What is the market capitalization? This is a $150 billion company, right? 150 billion, 277 million. That's the total value of the stock within this company. So it's a $150 billion company. Each company has its own valuation or market capitalization. Okay. There's a lot of talk right now about how Amazon is going to be the first company to become a $1 trillion market capitalization, which means that a lot of people invest in Amazon stock, and it's a company that a lot of people have faith will continue to grow and become big. Let's see. What is the stock price the prior trading day? The previous close right there. Okay, that's the prior trading day close. The open for this morning, when it first opened, was 55.31, and this is the current price up at the top in big letters. The current price that you could buy the shares at was 55.10. And that is, of course, right at about when it closed, because the market's closed, right? So this market closes at 4 p.m. Eastern Time or 2 p.m. Mountain Time. After that point, this number doesn't move anymore because you no longer can trade the stock. Okay? Anyway, you've got all the information you need. Really straightforward assignment for this week. Very, very easy. Let me know if you have any questions or concerns on it, but you should be in great shape, feel comfortable and confident just with the information we've just barely covered, that you'll do great. Okay. Let's go back to the slides. All right. So now you should see the slides instead of that Yahoo Finance screen. But this week's assignment question is that question on Merck gives you all the information we just looked at. You don't need to look it up. Please don't look it up, because we want the information off of their screen, that they provided in the textbook, in the e-textbook, not from Yahoo Finance, like a new one, right? Because this is 5 years. The information that they're giving us is 5 years old. So if you look up a new one, you're going to be giving me old, current information, but not the information that the question is asking for. The question is asking you to look at the information they provide. I was just giving you an example of an updated version of it for what we looked at. Okay? So make sure and look at the information the book provides, not what we did together tonight. I was just trying to help you know where to look for the various bits of information. Okay, so pretty straightforward assignment. This week's discussion board is really straightforward. So let's talk about, and it just talks about mutual funds and investment planning, how we use mutual funds, why we'd use mutual funds for investment planning, which most people use because they have a 401k or an IRA, and most 401ks and IRAs use mutual funds. So it's highly likely that you'll have mutual funds at some point in your life, even if you don't go seek them out and invest on your own. It's highly likely that one of the work plans or places that you work will have mutual funds within the 401k or retirement plan that they provide. Okay? So that'll be a good thing for that discussion board for us to discuss mutual funds. And also, I've mentioned ETFs, exchange traded funds, or something that we'll look into. So that's the discussion board. Stay up to date on that. And most of you are doing a great job on the discussion board. So let's talk about Chapter 11 after we get done. Like I say, talking about the key points of Chapter 11, we'll spend 5-10 minutes on the test this week. Make sure you know the topics that are on it. As I mentioned, 10 questions, all multiple choice, should be pretty straightforward, but we will give you that information in just a minute so that you can go through the e-text more purposefully. All right. So one of the key things is defining what investing is. A lot of people will say to me, as an investment advisor, I don't want to invest. Investing is the same as gambling. I might as well just go to Vegas and throw it on black, and it would be the same. Right? Sometimes I'll lose, sometimes I'll win. And, maybe I take it more personally because I'm a financial advisor and I help people with investments. But it always tends to, it always irritates me a little bit that they would compare investing, the investing that we're putting a lot of time, effort, and energy into making sure that our risk reward is in your favor, and that they would compare that to something where the risk reward is always against you or not in your favor, right? The odds are always against you when it comes to gambling. So, very key difference, right, between gambling and investing. Investing is something where you put the odds in your favor, and that over the last 85 years, the market has gained about 75% of the time, and it's lost about 25% of the time. In Vegas, at every single casino, you've lost about 51% of the time or more, and you've won about 49% of the time or less. Okay, meaning the odds are always against you statistically to win when it comes to gambling. When it comes to investing, if you do it in a prudent way, if you do your research, if you're diversified, even on a year-to-year basis, 3/4 of the time you're going to win. Okay, so the odds are in your favor. If you look over a 10-year period of time, you've never lost. The odds are always 100% that you will gain money if you'll keep your investments invested for 10 years. Okay, and in fact, on 10-year rolling averages, you usually have done very, very well. You're usually on pace to more than double your money every 10 years from the market on almost every 10-year period of time over the last 80 years. Okay? So anyway, there is a key difference between investing and speculating. Speculating is like gambling. Speculating is where you say, hey, I think I can make a call on what this stock might do in the next little bit, or I think this penny stock might go to $100, from 50 cents, or I think Bitcoin might go from $7,000 a coin right now to $20,000 a coin, which might happen, okay? Just like you might win the lottery or you might win in Vegas, but the odds are not in your favor when you start to speculate. Key difference between speculation and investing. Investing is usually longer term. It's usually diversified, usually more prudent. You're usually weighing the risks associated with that investment and doing your research. Speculating, you're just guessing, right? You're just trying to get lucky. And sometimes you might, and sometimes you won't. Okay, so big difference between investing, gambling, and speculating. How do I get started? A lot of people will ask, I don't even know how I should invest. How should I even get started? Well, there's a lot of different sites out there. In fact, one of the things that the textbook has, the ebook has this week in Chapter 11 is a list of all the online brokerages. And it's not all of them, but it's most of them. The big ones like E-Trade and Fidelity are on there. Trade King, Scottrade, ShareBuilder, those ones that we've heard about. Usually when I'm talking to somebody about starting investing for the first time, I like to have them go to a site like E-Trade or Ameritrade or Fidelity, because those sites are well known, they're big, they've got lots of different products, they've got lots of good educational services and resources within their sites, to help you learn as you go. But there are a lot of different sites out there, and as long as you're using a legitimate site, they're safe, they're secure, your money's safe. Your money's safe, but it still will go up and down with the market, right? So it's not like when they say your money's safe at a bank. When your money's safe at a bank, it's got FDIC insurance. It cannot go down. If you put $1 in, you're not going to have less than $1 the next day. In an investment, depending on which investment you choose, you definitely could have less than what you put in. It doesn't mean it's not safe. That broker that you're using, whether it be Fidelity or Trade King or Scottrade or Ameritrade or Schwab, those are safe brokers. They're good companies. They're keeping your money safe, but your money, the value of your investment is going up and down because of what you invested in, right? So how could you get started? You could start a savings program like we talked about. You could automate some kind of savings program where you pay yourself first and you put a little bit of money away each month. If you don't have a 401k or IRA that's provided you where you're automatically putting some of your payroll into your retirement, consider opening an account at one of these sites like Fidelity or Vanguard or Schwab. Notice I change the names almost every single time. I don't have any preference, and I'm not trying to sell one of those sites. It doesn't matter to me. But go do some research on them and see which one is easy to use, it has a nice interface, makes things look easy to accomplish, getting around the site, doing research, things like that. And then go with that company and consider opening an IRA of some kind or some kind of brokerage account and investing a little bit. So you don't need a lot of money, but it is important to try to start somewhere. And then take advantage of automatic investment and dividend reinvestment programs. So something where you can automatically take the dividend from the stocks that you have and reinvest it back into that stock. Usually doesn't cost you anything to have that. So normally a stock trade might cost you anywhere from $5 to $10 a trade. But when you reinvest dividends, it shouldn't charge you anything. So let's say I owe a bunch of GE, which I'd be sad about today because GE was down about 5%. They cut their dividend in half from about 4.5% down to about 2.25%. So today's a sad day for GE or General Electric. But if I own GE stock, I take that dividend every quarter that they pay me, and I can reinvest it back into stock, and it doesn't cost me anything. Where if I took new money from the bank and invested in GE stock, I'd still get charged my commission, right? My transaction commission, which might be $5 or $10, per trade. It's not a huge difference, but it does save you a little bit to automatically reinvest. And another thing that I think is great, and I've mentioned I think as much in this class or at least on the board, is using a site like Investopedia to practice trading. So you're going to practice trading before you ever put your own money at risk, right? So you go into a site like Investopedia, you do what's called a simulator, you invest their money, not even their money, fake money, you play money, into different stocks, you practice different types of trades, you see the different commissions come out, the $10 per trade or whatever you set it at. So you can get an idea of how that feels, what it looks like, and then your account actually grows or decreases based on the stocks that you put in. So it's a good opportunity to see how volatile, and how much these accounts can fluctuate once you get invested. Investopedia is one that I've used in prior classes where we've had stock trading simulation games, which I think are very, very educational and good from an experiential standpoint, just to get some experience with investing without having to put your own money at risk. A lot of times people will come back years later and say, hey, I did really well with the simulator. I didn't do well when I tried to invest my own money. And that could just be luck, right? Just timing and luck of when you invested and how the market was doing. But a lot of times there's something more at play. And the reason I bring this up is because a lot of you may experience when you're playing a stock trading game some success, and then when you put your own money in, you have a hard time making money. And it goes back to the psychology of investing, and that is that when you put your own money at risk and watch it go down, that's hard to watch. And a lot of times people will panic and sell when things have gone down. Well, there you just secured your loss. When you're playing with somebody else's money, or when you're playing with play money, like an Investopedia, if it goes down, you don't worry about it, right? It's not your money. You're not going to take a loss. You'll just wait for it to come back up if it's a company that you like. And when you wait for it to come back up, a lot of times it actually does. Okay, most of the time it actually does. And then, if it's play money, when it goes up, you're willing to take profits and take some profits on the side and do something different. Where a lot of us with our own money, we get attached to certain positions that have gone up for us, and we hang on to them too long after they've gone up significantly, and then they come back down. So sometimes not having it be our own money and not having the emotions of greed and fear kind of control our investment decision making, which happens to a lot of people. They get greedy when things go up and they hang on too long. They get fearful when things go down and they hang on too little. They get out too early and they take a loss. And so the average investor over the past 20 years, statistically, we know what they got, which is about 2.3% returns. If you look at what the market did over the past 20 years, it's more of an average of 8%. So there's a difference of about 5.7% per year that the average investor is not getting because they make poor choices with when they get in and when they get out. They're getting in when things are hot. They're getting out when things are cold. It's the exact opposite of what you want to do. And most of us know that logically, but when it comes to using our own money and getting emotional about our own money, we make mistakes. So, long way of saying some of these simulators are a great way to practice, because then it's more likely that when you're in the moment and it's your money, you'll be more likely to make good decisions if you've practiced making good decisions. Okay? And then make sure that you're careful to determine your objectives. Don't just jump into any investment randomly. Actually look at your investments and find out, and determine why it is that you would be investing what you're investing. So what's my objective? Is my objective for current income? Is my objective for long-term growth? Is my objective to speculate? Because if it is, right, you're just gambling. And so don't be upset when it could go against you or do something that you don't expect. Is my objective preservation? If it's preservation, maybe stocks aren't the way to go. Maybe I should be investing in CDs or annuities or something that has guarantees associated with them. So all I'm saying is just make sure that you're clear on your objectives and the risks that you're willing to take before you ever start investing your own money, because then you'll have, then you'll be able to stick to that objective or that strategy a lot better when it starts to move around. If the stock goes up and down and you don't have a goal or objective, it's a lot easier to make a mistake and get out when you shouldn't or get in when you shouldn't. But if you've got a long-term strategy in mind, it's not that it's easy, but it's easier to make sure and stick to that strategy and make good decisions. So here are some examples of different things that you might save for. You might want current income. Like real estate pays current income, right? Pays us rent. But so do bonds and so do stocks. So do mutual funds. They pay us some kind of current income that we can take. Some accounts have more income than others. And so, we just want to look at that, and that helps you to determine what you should do. Retirement, of course, that'd be a long-term strategy for most of us where we're trying to invest for the long term. You may have something like college education, a down payment on a house, or starting a business that you're saving for. Those are all big major expenditures that you can save. And then a lot of people invest for purposes and have an investment objective actually, and are trying to save in taxes, trying to reduce their taxes. And so that's another reason that people will invest and could be an objective. Now, it's likely in many cases that your objectives could be mixed between these or a balance between them, right? It doesn't often happen that people only have one objective. A lot of times people will have mixed objectives, and in one place they're trying to save for the long term, and in another place that they're investing they're trying to save short term, right, and trying to save for an expenditure that's coming up. And so it just depends on where you're at, what you're trying to do, but it usually breaks down between different things, how you're going to invest and what kind of risk you're going to take. So when we've determined what our objectives are, we need to come up with the number we're trying to accomplish. So how much money is it going to take is the question. And, some people, they save their whole lives for retirement. They never, ever had a specific goal in mind. And so what I would say is you're more likely to be more successful when you're saving for the long term if you have some kind of objective that's long term in mind, and you go backwards from that, right? So if I'm trying to save $1 million for retirement by age 65, I take that $1 million, I back it up based on an average return to the age that I'm at, and how many years and how much I'm going to put in, and I determine how much I need to save to accomplish that goal. So you have a more directed, more purposeful program to get to the lump sum that we need to invest in. It's very easy to use an online calculator. There's lots of calculators out there, bankrate.com, any investment company site like a fidelity.com. Even if you don't have an account, you can use their calculators to determine how much you need to save to accomplish a goal that you have. Okay? So how could you invest? There's lots of different things you can invest in. You can invest in stocks, what we call common stocks. You can invest in bonds. You can invest in preferreds or convertibles. So these are convertible bonds or preferred stock. You could invest in mutual funds, exchange traded funds or ETFs, or exchange traded notes or ETNs. And you could invest in real estate, or you could invest in real estate. And I will tell you, I have a lot of clients who get to a point at some point and they actually have all of these different things. They've got exposure to all these different types of investments, not because they're all rich, but just because they're trying to diversify, right? They're trying to do different things. You could even add things like gold and silver, precious metals, oil and gas, business interests. There's lots of different things that you could invest in. Most of us end up in something like mutual funds, real estate, stocks. Those are the most common ones on this particular list. Okay. What are they? Just a quick Investments 101 refresher. Most of you already know this. Common stock is equity in a company. That's ownership equity in a company. So if the company goes up in value, then theoretically the stock would go up as well. The stock market, though, is a little bit more fickle. It's pretty volatile, but over long periods of time, if companies make money and are profitable and grow and expand their franchise, whatever company they are. So if GE were growing significantly, then the stock would be up. But unfortunately, GE has been through a significant management change. They changed CEOs, and the new CEO has a plan for 5 years out, but the market was not confident in that new CEO's plan, and that's why the dividend was cut and the stock went down. So that's stock. Bonds are debt. So when we talk about bonds, we're not talking about equity ownership. We're talking about a promise for that company to pay you back with interest over time. So if I have a 5-year bond between me and Microsoft, and it's for $1,000, and they promise me 5%, they're going to pay me $50 a year, so 5% on $1,000, and then after the 5 years is up, they're going to give me my $1,000 back. Okay, so that's a bond. Preferreds and convertibles are a mixture between, so preferreds are a stock that kind of acts more like a bond, and convertibles are a bond that can be converted into stock. Okay, so just kind of a mixture, not as common as regular bonds and stocks, but nonetheless have a, are good, products that serve a purpose as well. Then we got mutual funds, ETFs, and ETNs. The basic idea here is that you're pooling different investments inside of an account and allowing people to invest in those accounts, and have exposure to all those different funds inside. So let me give you an example. So if I invest in the balanced fund, American Balanced Fund through American Funds, I'm getting like 500 different bonds inside of that fund and like 1,000 different stocks. And I'm just, rounding up, obviously. But the point is, you're going to have a lot of different positions inside of that. I only have to invest like $100 to get into that mutual fund. But yet inside that mutual fund, I've got exposure to all those different stocks and bonds. So it's a way to become diversified, to have economies of scale with lower investments, to have professional management, to have lower costs. I don't have transactional costs usually when I do mutual funds, where I do when I do stocks. So mutual funds are an age-old, time-tested way of basically having an investment strategy that somebody else manages for me. Okay, that provides diversification and professional management for me. All right, and then real estate, of course, most of you are familiar with real estate, maybe more familiar with the real estate in the sense of like your own home. A lot of people invest in real estate for purposes of income, right? They'll invest in a rental property, or they'll invest into a management group that manages apartment complexes or commercial property, and then they'll collect an interest payment over time from that. So that's a different kind of investment option as well. So we've kind of gone through each one of these already. Common stock is ownership in a company, high potential return. Bonds are usually more conservative. They represent debt, pay us back with interest over time. Got preferred and convertible securities. I mentioned that what they are, they're kind of a hybrid of both of those. Got mutual funds. This talks about what the advantages of mutual funds are. They're professionally managed, and they're diversified. Exchange-traded funds are designed to track usually a category or index. Okay, ETFs are becoming very popular. In fact, as far as flows are concerned, the past 6 months, flows in or out of mutual funds and ETFs are getting more new money into their, that category of investing than mutual funds are of late, even though mutual funds have a lot more money already in them because they've been around for a lot longer. Exchange-traded notes are notes that basically the issuer is tracking some kind of measurement, and they're just promising you a return on that exchange-traded note. Okay, similar to exchange-traded funds, but a little bit different. You got real estate, of course. A lot of people invest in real estate and gold and silver because they think real estate and gold and silver never go down. Of course, 2008, 2009 was horrible for real estate, and last year was horrible for gold and silver. It's just these cycles on gold and silver and real estate tend to be different. The ups and downs tend to be different than they are for stocks and bonds. They don't tend to move as much as stocks do, although they can move very dramatically at times. Okay. All right, so what are securities? The securities market is basically the arenas, the securities markets are where the buying and selling of different investment products take place. And the capital markets are usually long-term securities, and the money markets are usually short-term securities. So when you have a money market fund or a money market mutual fund at the bank, those money markets are short-term instruments, right? They don't go up and down, they don't fluctuate, they don't have risk. You just get a little bit of interest, very little. And when we're talking about capital markets, we're talking about stocks, bonds, mutual funds, something that's longer term, more traditional investing that's longer term, and definitely has more fluctuation risk than the short-term money market type products. Got two different securities markets. You've got the primary market and secondary market. Primary market is where you have new issuances. Secondary market is where you trade between different companies. So, just as an example, the primary market is where someone would, a company would release a new stock issuance. So, for example, Snapchat just barely had an IPO, or initial public offering, where they released their stock for the first time to the public. Public was able to buy in, and then now, if you were to buy Snapchat, you're buying it from somebody else. You're not buying it directly from Snapchat. You're buying it on the secondary market. So when a company has an initial public offering or has some kind of offering of new stock, that's the primary market. When you go to buy and sell stock from the New York Stock Exchange or the NASDAQ, those exchanges are facilitating buyers and sellers from each other. Meaning, if you want to go buy Microsoft tomorrow because you think Microsoft is a great company, and you go onto E-Trade and you buy Microsoft, you are not buying Microsoft from Microsoft. You are buying Microsoft from another seller somewhere else. So what does this mean? Well, with companies that are highly traded, like Microsoft or Apple or Google or Amazon or any big company that you can think of, these companies always have buyers and sellers. There's millions of shares, and there's always people willing to buy and sell it at a given price any given day of the week. When you have smaller stocks or smaller companies, penny stocks in many cases, you don't have lots of buyers and sellers. And because of that, the pricing fluctuates more dramatically. And in addition to the pricing fluctuating more dramatically, you also have a situation where sometimes you can't even sell whatever your shares are. And so just be aware of that you could get stuck in a situation. If it's a small company that nobody's heard of, you could be in a situation where nobody will buy your stock. Where if it's a company that people have heard of, or at least a semi-large company, there is usually always buyers and sellers and opportunities to be able to sell what you have. All right, so that's the primary and secondary market. I've got the broker market and dealer market. Not enough of a difference there to really look at it, but here's a diagram of it. You got the national exchanges like the New York Stock Exchange. Then you've got some regional exchanges. Then you've got dealer markets like the NASDAQ and the OTC. You've got bid price and ask price when it comes to buying and selling stocks. Bid price is what people are willing to be able to sell it at, and ask price is the price which we're willing to buy it at. Okay? So when you see a bid price, that's where somebody's willing to sell. If you see an ask price, that's where somebody's willing to buy. And usually there's, on a stock that's highly traded all the time, like Microsoft or Google or Amazon or Netflix or, one of these big companies, those companies, their bid and ask price is usually only a penny or so different. It's very efficient. People are always buying and selling, and so the bid and ask price are very close together. If you're dealing with a stock that's not very efficient, not very highly traded, or what we call thinly traded, where there's just not very many buyers and sellers, then you'll see sometimes an extreme difference between the bid and the ask price. People who are trying to sell it might be selling it for, willing to sell at $10 a share. People who are willing to buy might only be willing to buy at $1.50 a share. So there are no trades going on because nobody's willing to sell at $1.50 and nobody's willing to buy at $10. And everybody's hoping that, the other one will bend or break, in order to sell or buy, that particular stock. So that's the bid and ask price. You've got, of course, foreign securities markets. You've got regulations on the securities markets. And, there's a lot of new regulations based on what happened in 2008 when it comes to the securities markets, a lot of new regulators, a lot of new laws and rules. These laws and rules cost a lot of money to regulate and to implement for different investment firms. And so I work for an investment firm, so a lot of times what I'm hearing, obviously, from our perspective is that these are really costly regulations. These are really costly changes. And of course, they have a lot of lobbyists back in Washington, D.C. trying to roll back all these changes that took place under Obama after 2008. However, the flip side is most of these regulations were put in place to protect you and I as investors, right? So there's got to be a balance. It's not that we should have so much regulation that businesses can't operate, but it's also not that we should have no regulation and so businesses can do whatever they want, because we know historically if they can do whatever they want, they get in trouble. Okay? So the hard thing for politics and for businesses and for individuals is to try to strike a good balance between enough regulation to keep people safe and keep people's money safe, but not so much regulation that we create a problem, for businesses trying to make money in investments. Okay, so that's the challenge. The SEC, or the Securities Exchange Commission, is the largest. It's kind of like the IRS of investments, where the IRS is for taxes, the SEC is for investments, and there are a lot of other agencies that get involved with the regulation of investments, but the SEC is kind of at the top and kind of establishing the laws. Lots of different rules, big ones that have been put in place. Dodd-Frank, most recently in 2010, has a lot of these new rules that we just barely discussed that people, that's still up for debate on whether or not they're too punitive for businesses to really operate within the investment world. A lot of businesses are going out, going under because of all the rules, that they just can't keep up with all the rules and regulations. And then there are rules that go all the way back to 33, 34, and 40 after World War I and after the Depression era and stock market crash back in the 20s. So there are a lot of rules that were put in place in 33, 34, and 40 to try to prevent some of the problems that took place back then. And a lot of rules don't last, almost 100 years, but these rules have been in force. Many of them have been in force, at least in not entirely, but the majority of these rules have been in force for almost 100 years, which is pretty extraordinary when you think about it. So these were reactionary rules that were put in place to try to prevent the problems that we had back in the 20s and 30s, and they've been in force for a very long time and kind of been the standard rules when it comes to investing for all these years. Of course, there's something to be said for updating those rules. Some of them are a little bit archaic and a little bit out of, they're not workable anymore. So we have to be able to update and be flexible to be able to change those rules sometimes. So what are we talking about when we talk about a bull market or a bear market? A bull market is a market that is up, that is going up. Sometimes we'll just reference any market that's positive as a bull market, and any market that's a bad market is a bear market. But technically speaking, a bear market is a market that's down over 20% from its highs, and a correction is any market that's down over 10% from its highs. Okay, so even though sometimes we'll always talk about bulls and bears, and just sometimes we speak about it like they're just terms speaking about which direction the market is going that day. No, that's more like the market's up or the market's down. That's not today it was a bear market or today it was a bull market based on it going up a few hundred points or down a few hundred points. That's just up or down. And then we have corrections that happen when the market's down 10%. And then we have bear market. Technically, we have bear markets when the market's down over 20% from the highs. And you'd be surprised that we actually have bear markets more often than you would think. Statistically, over the past 50, 60 years, the market averages a drawdown from top to bottom of about 14% intra-year on average every single year. Okay, so that's not that we end up down on average 14%. I've told you before that on average 3/4 of the time the market actually ends a year positive, that we make progress. But intra-year, meaning throughout the year, at some point in the year, usually there's some volatility. That's what the stock market does. And on average, that volatility represents a 14% change from top to bottom. So we have a lot of corrections in the market. We even have quite a few bear markets. It doesn't mean that the market's not a good place to get good returns and to grow your money. It just means that you should be willing and understanding of the fact that there will be fluctuation and there sometimes will be corrections in bear markets, and it's still okay, still long-term a good place to invest. Different ways that you can make transactions in the securities markets. Most of this has become electronic. There are very few stock brokers, broker types that sit on Wall Street's floor and call people about the latest tips. Most people, are not needed on Wall Street's floor. In fact, for a lot of years, Wall Street, it's just packed. The floor on Wall Street, if you were to go to New York City, was just packed with different brokers trying to do trades. And now, it's busy, it's lively, but it's more of a show. There's not nearly as many folks on the floor on Wall Street. Most people can do what they need to do electronically. And for you and I, that means that costs have gone way down. So historically, I would pay 2 or 3% on a trade. So if I traded $100,000 into a stock, I might pay $3,000 or $4,000 to get that trade done through a broker, through their commissions. But now I can take $100,000 and trade it into whatever stock I want online through Fidelity, E-Trade, Ameritrade, whatever it is, Schwab, and I can do it for $10 flat without any other fees or charges. And so it's become much less expensive to trade stocks because of things becoming more electronic. So here's kind of a bell curve of stock returns. See on the right, all these ones on the right are positive returns, okay, over the past 100 years. And all the ones on the left are the negative returns over the past 100 years. So you see over the past 10 years, well, looking at 2000 to 2010, so not the last decade, but this would be very similar in the last decade as well. You've got 7 out of 10 on the right side, so 7 out of 10 of the years were a positive return, and you've got 3 out of 10 of the years are a negative return, including a really bad one in 2008, as you all remember. 2008 was tough. But I think graphically this is an important chart to just basically help you understand as well that, again, about 2/3 to 3/4 of the time the market's up. You can see that by looking at this. Most of the years are on the right side. They're positive. But about 1/3 of the time, or depending on how many decades you're looking at, sometimes as much as 30% of the time or 33% of the time the market's down. And if you know that before you invest, then you'll be able to, it'll still be painful when that happens, but you'll be able to stomach it when it does. Okay. All right. I think that's a really interesting graphic. I've got lots of different brokers, like online ones. We've already talked about that, and you've got a list of those in the book, in the e-text as well, and a comparison between them. You got full-service brokerage houses like mine. Zions Wealth Management through Zions Bank is considered a full-service broker. Then you've got discount brokers that allow you to trade for a discount fee, and they don't really offer full-service advice, even though maybe they might purport it, but that's not really the model that they're in. They're just there to give you some advice and then to help you execute the trade. And then, like I say, where a lot of people do stock trading now is through some kind of online source like the ones you see there. Having said that, I don't even, as a financial advisor through Zions Wealth, even though I can trade stocks for people, if somebody comes in and asks me to trade a stock for them, I'll usually encourage them to just do it online themselves. Instead of me charging for that trade, they should just do it online and save themselves some money. So anyway, a lot of those full-service brokerages like a Raymond James, Edward Jones anymore, if you were to go to them and say, hey, I want to trade a stock, they might say, you know what, that's not what we do. We're helping people with portfolios and strategy, investment strategy, and financial planning. So if you just want to trade a stock, a good way to trade a stock is just online through one of the discount brokers. Investments don't have FDIC in coverage like a bank does. FDIC covers 100% of your balance up to $250,000. SIPC coverage insures up to $500,000, but it's basically fraud insurance. It is not insurance against the value of your account going down. The value of your account probably will go down if based on the information that we've been talking about in the stock market. The market goes up about 2/3 of the time, goes down about 1/3 of the time. So before you even invest in a stock that some years are going to be bad and some years are going to be good. Most years are going to be good, some years are going to be bad, right? SIPC coverage just insures you against somebody doing something fraudulent. So in the case of Bernie Madoff, he did have SIPC coverage. His clients did have SIPC coverage. So let's say you invested $20 million with Bernie Madoff. You lost everything because he was a fraud. And SIPC insurance would give you $500,000 in coverage based on that fraud. Now, that wouldn't feel very good based on having $20 million. I did, though, recently read an article that says that most people will get back anywhere from 70 to 90% of their initial investment in Bernie Madoff because they've been able to recover a lot of his assets, a lot of the family assets, and sell them in order to help folks who invested in Bernie. Anyway, that's a different issue, but just did want to bring up SIPC coverage. It does protect you against fraud as long as the company that you work with is a legitimate company, a licensed company that has SIPC. Just like banks, if you work with a bank that doesn't have FDIC, then you don't have FDIC, even though it's a bank. Banks have to pay premiums to be FDIC insured, just like brokers have to pay premiums to be SIPC insured. So if they're SIPC insured and you've got coverage up to $500,000 against fraud, if they're not, you don't have that coverage. We talked about the different types of orders last week: market orders, limit orders, and stop loss orders. I don't think we need to go over that again. I do think it makes sense to spend a few minutes here, and then we'll go to the test material, on how you as an investment person can become a little bit more informed before you invest. We talked about Investopedia as a great place to practice investing, but practicing investing just helps you with the logistics of how to invest and then how it feels once you are invested, which are very important. But perhaps more important than both those things, or at least equally important or more important, is the fact that you understand why you're investing in what you're investing in. Whether or not you use an investment advisor or not, or a broker or not, it's important to understand why they make the decisions they make. It'd be similar to deciding that you wanted to buy a car, okay, but doing no research before you get to a lot, okay? So you get to the lot and the salesman is just going to sell you whatever he's going to sell you, right? There's no rhyme or reason in many cases other than he's going to sell you maybe what he can make the most commission on, or what he thinks is going to be the easiest sale. You allow him to dictate, or her to dictate, the agenda, right, when you go without having done your research. If you go to a car lot, you've already done your research online, you know where the pricing should be, you know what color you want, you know what model you want, you know what type of car you want, you know all those things, and you know what the pricing should be, then you can help set the agenda, and in many cases come away with a better deal, right? The same thing is true for investing, and a lot of people don't think of it this way, but it's like any other large purchase that you make. If you'll do your research and put a little bit of time in and effort into understanding what it is that you're trying to do, you will find that you're much more successful in helping get a good advisor, first of all, being able to research and get the right kind of advisor, but beyond that, be able to keep them, be able to keep the agenda in your court and keep them honest as far as what they're doing and how hard they're working for you. So how do you learn? Well, there's a lot of tutorials on Investopedia. There's a lot of information out there on Yahoo Finance, MSN Money. CNBC is one that I like. I read a lot of articles on CNBC about different stocks and different companies and what they're doing. But what it comes down to, more than anything when it comes to individual stocks, is the annual reports and the financial reports. So if you've taken a finance class before now, a business finance class, you know that there's a balance sheet, an income statement, and a profit and loss statement as well, right? Statement of cash flows. And so if you can look at these four statements and extrapolate information from them, as well as the annual reports where the CEO and the CFO will talk to us about what they're doing and how they're doing it, if you've got that information at your fingertips, which everybody does, it's all free information. You don't have to pay for any of that information. You can find it on many, many different sites. If you trade with Fidelity or have a Fidelity account, or even if you don't have a Fidelity account, you can use Yahoo Finance, Google Finance, MSN Money, CNBC, or you can even use Fidelity without an account and find information that we're talking about right now as far as financials, as far as analyst information, what they have to say about it, as far as expectations for current earnings and future earnings. You can find out dividends and yields. You can find out what their history's been on their stock price. All these different things can come into play when you're making a decision on whether or not you should invest or not with a company. And I would strongly encourage you to do some basic research before you invest. If you don't have a high conviction when you go to invest, what will inevitably happen is at some point that stock will go down on you and you'll get out at a loss, and you should have never invested in the first place if that's what ends up happening. If you have high conviction because you've done research and you really believe in a company and you're excited about a company and you're committed to a company long term, then you'll be more like Warren Buffett, who, when he decides to invest in a company, he's done his research, he's done his due diligence, he will invest in a company, and he will invest in that company like he's going to be invested in it for the next 20 or 30 years. Now, it doesn't mean he always is invested for 20, 30 years. Many times he is, but most times he is, but sometimes he isn't. But the point is, when he becomes convinced that he should invest in a company, and this is after research, this is after watching a position for a long time, this is after a lot of analysis, when he becomes convinced that he should invest because it's a good deal, he is highly committed to it. Meaning, if that stock then goes down more, he'll buy more. Okay, he won't panic. He won't sell it. If that stock goes down more, he'll just buy more. And if you're committed enough to do that, then you're probably making a good decision when it comes to your investing. If you're not committed to buy more if it goes down, then you're probably not at a high enough conviction level to make it a good investment for you. Because things like the fact that it's long-term and you're committed to it long-term have to check out. Things like you've done your research and you feel convinced that it's a good opportunity have to check out. And then things like, hey, I'm never going to sell this at a loss. I'm only going to wait for this thing to make me money, and it might take years, but I'm going to wait for it because I know that the company's good and I know it'll be a good thing in the end. If you know that, then you're in good shape, and you should be highly committed to keeping it long-term, right? To keeping that position long-term. And if you're willing to keep things long-term, follow kind of the Warren Buffett approach. Investing in the stocks can be a phenomenal opportunity. Lots of online tools, as I mentioned. You can do it yourself. You don't always have to have somebody else, but I would strongly suggest that you do enough research to know how you can be diversified in your approach. So instead of investing in just one stock, maybe investing in 5 or 6 different stocks, maybe making sure that they're different categories, different industries, so that they don't follow each other as far as the results that they have. So if you're going to invest in Microsoft, I probably wouldn't invest in Google, for example. Or if you're going to invest in Netflix, I probably wouldn't invest in a company that owns Hulu. Or if you invest in, Apple, I probably wouldn't invest in Samsung. Okay, I would pick what you thought was the best opportunity between Intel and AMD, and I would pick the one that you liked better as far as a chip company and go with it, right? And not necessarily hold both. Because then you're not as well diversified. Okay, so that's what I wanted to talk about as far as the chapter is concerned. Let's go ahead and go back and spend a few minutes on the test. Okay, so here are the test topics. The first test topic asks what the SEC requires corporations to issue before they sell a security. So there's something that the SEC requires of a company before they sell an investment of some kind. You can find that what that is. You'll get number 1 right on the test. Number 2 on the test, just make sure you understand the difference between the different exchanges that you can buy stocks on. You've got the OTC market, you've got different regional markets, and then you've got the national New York Stock Exchange. So which one of these is one that you couldn't locate on a map? If you know which one you couldn't locate on a map, based on the discussion that the book has about different exchanges, you'll get that one right. Number 3 on the test is just basically, can you define the difference between a bull market, a bear market? And if you can, you'll get number 3 right on the test. Number 4 on the test, just understand what a portfolio is. What is an investment portfolio? Number 5, you want to understand what is the difference between a stock that's listed on exchange versus a stock that's not. What does that mean when a stock's listed on an exchange? Not all stocks are listed. Okay, what does that mean? If you understand what it means to be listed on an exchange, you'll get number 5 right on the test. Number 6 on the test, you want to know the difference when you're talking about objectives between long-term growth strategies and short-term income strategies. What's the difference between having a priority of short-term income and long-term growth? How would that look different? What's the difference between those priorities, generally speaking? Number 7 on the test, deep discount brokers do what? What's the difference between full-service brokerages, discount brokerages, and deep discount brokerages? What are they doing? What kind of value are they adding for you as the consumer? You want to know the difference between those so that you can make an educated decision on how you invest. Number 8 on the test is a different kind of orders: limit, market, stop loss. I think you guys did a good job on the discussion board, so number 8 should be pretty easy, but it does talk about it in the chapter this week. Number 9 on the test, publicly traded companies. What are their requirements as far as reporting to their stockholders? What are the requirements of a publicly traded company to their stockholders as far as financials are concerned? And you might already know that from a corporate finance class. Number 10 on the test, just difference between bull market, bear market again. If you know the difference between bull market and bear market, you'll get 2 right on the test. You'll get that last one right as well. So that's all I have for you tonight. That's what you'll need to know for the test. Good luck this week with the test. If you have any questions as you go throughout the week with any of the coursework, let me know. Let me know if you have any questions on any of the graded material. Everything's been graded that was turned in on time to this point. So if you don't see a grade on something that you've turned in, make sure and get in touch with me. Just let me know. There always can be, mistakes, and so I just want you to take responsibility for your own grade. Check that you've got feedback. If there's feedback that you can do something to improve your score, that's in your court now. You can go ahead and accomplish that if you'd want to, or not. But I hope you will. I hope that you're all going to be successful in the course and pass it easily and get the grade that you want. If you have any questions or concerns, let me know. Have a great week, and we'll talk to you later.